If you thought saving the economy was complicated, just wait until you hear from the Federal Reserve. Last month, Raphael Bostic, president of the Federal Reserve Bank of Atlanta, laid out a delicate balancing act. On the one hand, the central bank seems to be winning its battle against inflation. On the other hand, new concerns about weakening the labor market are emerging like storm clouds on the horizon. As Bostic aptly commented, "I'm still laser-focused on the inflation target, but that economic balance is beginning to tilt, and the risks and costs to everyday Americans are becoming increasingly severe." Let's start by giving credit where credit's due. Inflation has indeed been crawling back down from its recent peaks, drawing applause and cautious optimism. At its height in 2022, inflation reached a staggering 9.1%, driven largely by post-pandemic supply chain disruptions, labor shortages, and soaring energy prices due to geopolitical tensions like the conflict in Ukraine. Prices soared across the board, with essentials such as food, gas, and rent putting pressure on consumers, especially those with lower incomes. Yet recent figures suggest it's declined to a more manageable level of 3.7%, according to the latest CPI data. Is this a victory? Well, sort of. Historically speaking, anything near 4% inflation is still above the Fed's target of 2%. While the worst extremes may be over, the overall problem isn't solved, only bandaged. But here's the kicker. There's always a cost. Lower inflation doesn't come for free. It's the result of rising interest rates, which we all know aren't just technical metrics. They directly impact how much debt we carry, how businesses invest, and housing affordability for the average Joe. What the Fed is essentially admitting, without actually saying it, is, sure, inflation's coming down, but now something else might break. And Bostic's job is about managing that balancing act. But is he about to tip it in the wrong direction? In September, the Federal Reserve cut borrowing costs by a half point, kickstarting another easing cycle, hoping to give the strong economy a much-needed breather. Policymakers, it seems, are playing a dangerous game, cutting rates to protect growth while simultaneously keeping inflation in check. Looking ahead, there is speculation that further cuts may follow, although Bostic himself seems a bit more conservative this time around, favoring incremental steps. Here comes the interesting part, though. The labor market is now the Fed's new battlefield, morphing from a supporting player into the main act. The question is, how long can the Fed manage this balancing act before something gives? Now, let's talk labor markets. The U.S. added a robust 254,000 jobs in September alone, pushing unemployment down to an impressive 4.1%. For many mainstream outlets, this was cause for celebration. Look, more jobs. Unemployment's going down. The economy is saved. But such enthusiasm may be premature. What these good numbers hide is an underlying fragility. Unemployment at 4.1% certainly sounds nice on paper, but beneath the surface are several concerning trends that suggest the labor market strength may be illusory. Sound familiar? It's like in the lead-up to the Great Recession when everything looked fine until it didn't. Let's get real. Much of these new jobs originate from sectors that generate low-wage and often part-time work. Industries like hospitality, retail, and healthcare. Over the past several years, wage increases in these sectors have barely kept up with inflation. Many workers are working more but earning less, as inflation eats into even modest pay increases. Real wages, what people can actually buy with their income, are still stagnant, pointing towards a growing class of working poor. So, while Bostic and his fellow policymakers celebrate the low unemployment numbers, what they conveniently skip is the problem of underemployment. In fact, the U6 unemployment rate, which includes discouraged workers and those marginally attached to the workforce, remains significantly higher than the headline jobless rate. The jobs we're creating may not be the ones America needs, but hey, who's counting? At the same time, labor force participation is still below pre-pandemic levels. Many workers, whether because of lingering health concerns or long COVID, aren't returning to jobs in full force. While some early retirees have re-entered the workforce amid cost-of-living pressures, the overall share of people actively working or seeking work remains lower than the Federal Reserve would like to admit. Oh, and as Bostic alluded to, there's a new threat that isn't getting enough attention: climate change. You might ask, what do hurricanes have to do with interest rate cuts? Actually, a lot. Hurricanes, wildfires, and other disasters are becoming more frequent and hitting regions like the southeastern U.S. This not only brings short-term devastation but also introduces long-term risks to local economies. When businesses can't recover quickly, supply chains are disrupted, production lines stall, and insurance costs skyrocket. We already know that flood-prone areas like Miami or Houston, for example, are seeing rising home insurance premiums at unsustainable rates. This will push housing costs even higher, potentially worsening affordable housing crises in these regions. The rising costs of climate-related disturbances are a growing risk to the U.S. economy, threatening to shift investments away from vulnerable areas and pose severe challenges to local job markets. Beyond that, you guessed it, the insurance industry is rethinking everything. People may simply find homeownership increasingly unviable, putting unprecedented pressure on rental markets and increasing homelessness in key cities. As the economy's backbone, banks, insurance firms, and regulators scramble to address these challenges, can we honestly say that Bostic's mild-mannered response packs enough punch for the growing severity of the crises? The bigger question is, what is happening to America's real economy? Sure, inflation might be managed somewhat better in the short run, but will the Fed's interest rate juggling act irreparably damage the labor market? And will these risks compound climate-driven disruptions? This leads us to the heart of the issue. Policy reactions over the last few years, whether driven by priorities of a lower inflation target or an over-optimistic job market outlook, don't always match economic realities. In fact, the increasing perception of low growth opportunities in developed economies is worth examining further. We may be headed towards an era of stagflation, where persistent inflation mixes with stagnant or slowing growth, creating a toxic recipe for future economic despair. But is anyone in Washington or the Federal Reserve bold enough to really address these deep-rooted issues, or are they continue with patchwork solutions that just kick the can a bit further down the road? Ladies and gentlemen, this economy we're living in today, a momentarily cooled inflation, a seemingly strong labor market, may appear in decent health, but what lies underneath isn't as great as policymakers would like you to believe. Inflation may have come down, but sustainable wealth isn't the same as job creation. The bigger risk, which authorities like Bostic are starting to acknowledge, is that without bolder shifts, we're keeping only half the problem from boiling under the surface. The challenges we're pressing against, continued sky-high interest rates, fragile industries, lower labor force participation, and the lurking specter of climate-induced devastation, set the stage for an economic reckoning far grimmer than policymakers are ready to admit publicly. And this is where I really want to ask you to stay sharp. Too often, we're fed narratives of success that look compelling on paper but fail to reflect the real burdens families, workers, and businesses face on the ground level. As long as these disparities continue to loom, it's not a question of if, but when, the systemic cracks emerge to deliver the next economic crisis. Prepare yourselves, because as long as we have experts like Bostic maintaining this delicate and risky economic ballet, we'll see many more missteps before the performance comes to an end.